Today, folks, we are finally seeing the one-to-one cause and effect of interest rate cuts versus interest rate sensitive stocks. And today I want to share with you how you can 3x leverage a potential huge return, especially within the real estate sector in the US, because Canada could be a bellwether to what happens to interest rate sensitive stocks in the US, because we haven't seen an interest rate cut yet. And I'm actually looking to take advantage of that. So we're going to break that down in this video. If it is a conversation you'd appreciate, as always, hit that like button, subscribe if you're on a path to financial independence, to perhaps one day retire early. But let's just get a sense of where the Canadian markets are at, because it really gives us a good clue into what's happening in the US, because our economies are so paired together. So here's Tiff Macklin, our own version of Jerome Powell, the money printing machine here at the Bank of Canada.
Today, we lowered our policy interest rate by 25 basis points to 4.25%. This is the third consecutive decrease since June. Our decision reflects two main considerations. First, headline and core inflation have continued to ease as expected. And second, as inflation gets closer to the target, we want to see economic growth pick up to absorb the slack in the economy so inflation returns sustainably to the 2% target. Inflation continues to reflect the push and pull of opposing forces. Overall weakness in the economy continues to pull inflation down, but price pressures in shelter and some other services are holding inflation up. Since the July MPR, the upward forces coming from prices for shelter and some other services have eased slightly. At the same time, the downward pressure coming from excess supply in the economy remains. If inflation continues to ease broadly in line with our July forecast, it is reasonable to expect further cuts in our policy interest rate. We will continue to assess the opposing forces on inflation and take our monetary policy decisions one at a time.
Yeah, it'd be nice to see the explanation too on exactly like what oversupply is causing downward pressure on inflation. Canada's been trading in the 2% range the whole year. It's no surprise we're getting continual interest rate cuts. I really don't think cutting interest rates today will have a major impact on inflation whatsoever at this point. Again, it didn't for 10 years. I hate that story of, oh, well, interest rates are going to cause more inflation. It's like, well, we went through a whole decade of super low interest rates and had no real impact on inflation. Now, I get in short-term spurts, you drop it too much, a lot of spending could happen all at once. I get it. But where it's really affecting consumers right now is obviously on that double-edged sword. You raise interest rates, mortgages cost more, the landlord's got to raise it on the tenant. There's more inflationary pressure just from raising interest rates that we could see alleviated as interest rate cuts come into play. And I'm kind of getting screwed on the interest rate cycle here because I've been 1 year into a mortgage right now that's I got a 3-year fixed at 5.89%, and now we're slowly bleeding below that. Now, my plan here is just to continue to make the extra payments, watch interest rates come down over the next year, and then on our third year, we just got to survive having a 5.8 mortgage and then knowing that renewal is going to come up, and we could break the term here. I mean, if you're stuck in a super high interest rate, I mean, sometimes it's worth just paying the couple $1,000s or whatever it is to break the term and then just immediately go to lower payments, lower interest payments. That's something that you could consider as well, but that's kind of the effect. I mean, if you own a mortgage, if you're in real estate, you're feeling this. So there's a direct cause and effect, attributed to the interest rate cycle here, especially on cash flow for major REITs, which is what we're going to talk about right now, because as we're seeing it in the infrastructure, I mean, today at the backdrop of a very red market in the US, TELUS is still green, BCE is holding some green. I mean, Fortis is up just slightly here, but has been doing exceptional as of heading into the interest rate cut cycle. Even Enbridge has been on a tear since the announcement of interest rate cuts. So we can see infrastructure and heavily indebted companies are starting to excel against the backdrop of this, right? So when you look at REITs specifically too, we're seeing a very big jump. I mean, Canadian apartment properties up 1%. I just accidentally closed the RioCan tab. My RioCan, who's got the RioCan out there, the clan for this stock, because man, it is now coming back. It's up 3% today alone. And the whole real estate sector, if we zoom in here on the year to date, really has been exploding. I mean, 20% since the interest rate cuts really started here in Canada. So what this means for the US is I think there's going to be a direct correlation, and Canada is the bellwether. Like, we're seeing a preview to what's going to happen with US stocks, especially like VNQ, which I recently sold out of. Many of you know I traded out of VNQ to diversify a bit into the obviously XLU, which is the utility sector ETF. And I still think that I could play the real estate sector in a shorter period of time. And I'm saying this because I recognize that real estate is the most interest rate sensitive, industry that gets looked at. It's the first thing that'll come to someone's mind when they think interest rates, maybe not utilities or things like Enbridge. So we're seeing a bit of a pop up here heading into the interest rate cuts. And a lot of people are saying, oh, well, this has been priced in already. And I really don't think it has. I have a hard time believing it has, especially if we're heading into a full year of continual interest rate cuts. So I've been looking at something like DRN. This is the Direxion, if I'm saying that correctly, Daily Real Estate Bull 3X. So this is like your TQQQ, but in the real estate sector. And recently, as VNQ has been rallying in many of these real estate stocks, this thing is now up 46% just within the last couple, 2 or 3 months. And if we get a historical period like we did from 2021 coming out of the pandemic level, which is a big shock to real estate, I mean, this thing rallied up over 100% just within a year. And I'm having a superstition that we're going to see something very similar unfold again, right? So I'm debating on taking a small position in this just to continue to try and excel broader market performance. Somebody that manages a portfolio is a YouTube channel that is continually trying to outperform the broader markets in the safest way possible. I don't see, throwing a few $1,000 at something like this to try and just, get a quick year return on the continual interest rate cuts. I just feel like it's itching me that it's like the easiest play in the market right now because like I'm not too comfortable buying TQQQ. There's a lot of volatility in tech all the time. But real estate has gone through its most epic disaster it's seen in such a very long time. And it is a very stable sector. And we're just starting to see what I think is the glimpse of the return, right? So why not try and maximize it, take on a bit more risk with a smaller amount of capital? Because again, I'm not looking to hold the sector long term. Again, for me, I could see anybody holding it long term. For my parents, I think this is a great ETF. For me, looking for diversity, I own real estate already. So I just want a bit more diversity in my long-term portfolio. That's why, again, I chose XLU, which is, again, an interest rate sensitive industry that has been excelling on the backdrop of so many things, because obviously the electrification future is really going to drive up, I think, huge demand for the energy sector here, or the utility sector as a whole. So I like having that exposure. So we'll see what I end up doing. You can consider subscribing. But yeah, this, I've been looking at things like TELUS, and I want to keep cost averaging into some good stocks. But in the meantime, I just can't help but see this being perhaps one of the most opportune plays. It could just be the gambling addict in me, that devil and angel of long-term SP 500 and short-term, buy Tesla now on the dip and then sell it when it rips. But I'd love to know what you think in that comment section below.